Hey everyone, welcome back to the channel. This is another episode of my M1 Finance portfolio series where I'm attempting to reach a $100,000 portfolio in this platform, M1 Finance. M1 Finance is a free-to-use platform, and you can check out my affiliate link in the description below if you're interested in checking it out. I also have some videos going over the main features and some tutorials in using M1 Finance if you're interested in those. But where we last left off, things weren't looking too hot for the portfolio because we're in a very volatile market right now. We've seen pretty violent swings in a lot of different stocks. The overall market hasn't moved all that much, but my individual holdings certainly have moved quite a bit, and I want to get into that in this episode. But I also want to go over my plan for this increasingly volatile market and how I intend to do things moving forward. But basically, what I was doing over the last month was I was adding a lot of money into holdings that had recently taken a dip, mainly Turtle Beach. I put a few thousand into that when it got as low as about, $18? And now it's back over 21 in a relatively short period of time. I'm not saying that I expected that to happen. It's really hard to say what would happen in the short term for any stock, because there's just so many factors that go into it, a lot of emotion at play, and it's very hard to predict emotions, especially when we're talking about a large group of people. If we go on over to the activity log, we can see some of the moves I've made over the last month, and it's been pretty much all buying, though notably one sell. I'll get to that in a second, but back in January, I bought some Sleep Number, bought some Smith & Wesson. All of these stocks had dropped quite a bit from my initial purchase price. Same thing with another purchase of Sleep Number. And then one of my biggest purchases was actually towards the end of January with Turtle Beach. I did about $2,500 in one day, which was most of my remaining cash at the time. A couple of days later, I bought some more Smith & Wesson. That same day, I actually bought and sold some stock. I sold some Equity Commonwealth, which is largely a cash pile. So I almost look at this sort of like a cash equivalent with a little bit of equity upside. It has some equity downside, of course. It's a REIT that's mostly cash that has some office buildings as well, but generally it's really almost like a SPAC in real estate terms. So I actually sold a little bit of that to buy some more Turtle Beach when it was below $18, which was well below what my buy target was. And then in February, the only purchases I have been making actually have been in Facebook or Meta platforms. So it took a pretty hard dive at the end of February, and it's not quite in my ideal wheelhouse where I'd want to really take a big swing at it, but I've been kind of nibbling to build up sort of a feeler position, and now I'm going to pay some very close attention to Facebook stock. And if it continues to drop, I'd probably look to make it a much larger portion of the portfolio. Right now I have around, $1,500. If we go back to the portfolio view into the big tech slice, and Facebook here is at around $1,400. And I'm actually scheduled to buy a little bit more on Monday, though that'll be dependent on what the price is. I'm filming this as of Sunday, February 13th. Same goes for Alibaba. I do have an order slated for Alibaba as well, but again, no guarantees that I actually go through with these trades since they are scheduled for tomorrow and I could change my mind. And that's partly because stock prices are moving quite violently every single day. So one thing you might notice is that I'm continuing to buy in this market, even though it's been relatively negative. Yet, let's see if we go to the 1 month view, what's happened in my portfolio. It's actually up slightly. I was actually a little bit surprised to see this. I think a lot of this was because Turtle Beach recovered a few dollars per share shortly after I put a pretty significant portion of my remaining cash into it. And again, I'm adding new cash to this every month. So it's not as though as soon as I deploy all my cash, I'm never going to have any more. More is coming in. This portfolio is still relatively small compared to my future earnings. But this isn't to say I'm some sort of genius, because I had no idea what was going to happen with the stock price when I bought really any of these stocks. They could have kept going further down. They could have suddenly gone up. I don't really know what's going to happen. All I can focus on is the deal in front of me. Do I think it's a good deal relative to my assumptions and my own risk tolerance? Then I make the decision from there. I also have to factor in whether or not there might be a better use for that cash. Maybe there's a better deal I could put that money towards. But that's kind of the secondary level of that analysis. The first thing is to say, okay, would I rather have this in cash or would I rather put this into this investment? And this is money I don't need in the short term. This is disposable income that I am putting towards my investments so that I can then have greater income theoretically in the future if all goes well. That's the name of the game in investing. It's delayed gratification. But of course, my portfolio is not out of the woods yet, and frankly, it never will be. There are always going to be different risks associated with any sort of investment. There's a chance that things don't pan out. There's a chance that you have sort of macro level risks that you really can't do a lot to control. But for example, we have a lot of news about the Federal Reserve and the presumed interest hikes that we're probably going to have in the future, at least if we're going to take what they say at face value. And there is an emergency meeting scheduled for, it would be the day before this video comes out. I don't know what the results of that meeting are going to be since I'm filming this the day before that, but in any event, there are lots of different things that can affect the market in the short term. So I always try to focus on the fundamentals of each individual business that I'm buying into instead. And instead of trying to do the enormously difficult task of timing the market, I instead look at the fundamentals of each investment that I'm going for on an individual basis. How does this investment stack up to my own preferences for what I want to invest in? And does it meet my return requirements? And all those great things that are really up for each individual investor to decide. And frankly, it makes otherwise volatile times like this a lot easier and I guess more fun to invest in because I'm just looking at individual opportunities. And instead of trying to guess which way the market is going to go, which is incredibly difficult to do over any significant length of time, I can just look at each individual deal and go from there. This brings me to my plan moving forward, and it's a 3-step plan, I suppose. First step is to continue adding cash to my portfolio. Right now, my portfolio is not a particularly life-changing amount of money. It's not as though I'd be financially independent with this portfolio I have right now, and that includes my real estate investments. Sure, it's helpful to have some of these investments as sort of a next level emergency fund if I totally run out of cash and need more assets to draw from. It's helpful to have that, plus the income that these assets throw off. It's all great, but it's not at the level where I could be financially independent, and I want to get this to a much, much greater level. So I'm going to continue adding cash to this account because the income I'm making is significantly greater than the potential investment returns that I would expect, at least in the short term. Eventually, that won't be the case once the portfolio becomes big enough, and then investment returns are going to be way bigger than any amount of cash I could actually add to the portfolio in a given month or year. But barring some major unexpected event, I'm still pretty far away from that point. Now, the second step of my plan is to take that cash and buy when something meets my criteria. So when something has attractive return potential compared to the risk that it proposes, then I'm going to go for that investment. This goes back to what I was saying earlier, looking for individual deals, seeing if those deals meet my criteria and going from there, rather than trying to time markets or make big macro predictions. As much as I'd like to do that, I think I'm pretty knowledgeable on a lot of the topics, but even then, there's just so much to unpack when you're trying to predict major market moves. And in many cases, you could be totally right about a macroeconomic prediction, but it might not actually come true for 3 or 4 years after that. So at that point, it was really helpful to adjust your portfolio to try and address that concern you had. If it didn't really actually come true for many years later, you have that big opportunity cost of waiting for your prediction to actually come true. It's an extremely difficult game to play, and I'd rather just look at the individual deal and go from there. And the third step of this incredibly complex plan is to buckle up, because there's going to be volatility in pretty much any investment you pick. Some will have less, some will have more, but the fact of the matter is you don't really know what direction the market's going to go in the short term, and even individual holdings. Your analysis could be great, but people could totally disagree with you in the short term. Even if you're right long term, you never really know what's going to happen in any given period of time. But as long as you're not over leveraging yourself, you're making reasonable assumptions, you should do okay in the long term as long as you can hold on, which is another hard thing to do. There's a lot of discipline involved with long-term investing, especially because of all the volatility we do see. It could have been very tempting to sell off a bunch of my holdings over the last month as the market started to trend downwards, since you want to take those profits after all, and sure, that's great. It probably would trigger a taxable event, but hey, you get to take those profits and then wait for a better opportunity later. But really, you never really know what that next opportunity is going to be. And if the one you're currently invested in still looks pretty good based on your risk tolerance and your risk profile, then why leave it? And if you are really worried about a short-term dip in the stock market and you're not like a day trader or something like that, then one, you probably shouldn't be investing in the stock market, at least until you can either be more disciplined, or if you have too many expenses or too many debts that are really having you worried to where you can't be disciplined, then maybe you want to focus on those first. This is up for you to decide, and I can't really tell you what to do, but do take a look at your whole financial picture. And if you don't have the stomach to go through some pretty serious market volatility, we're talking about big drops in large portions of your portfolio, then you probably aren't ready to invest in something as volatile as the stock market. But I suppose the only way to learn whether you do have the stomach is to actually go through it. And who knows what the future will actually hold. But if you need help with your investing, then definitely talk with a licensed financial professional. I'm not one of those. They can help you with specific financial advice for your specific situation. And if you need that, and maybe that's the extra push you need to get you that extra discipline, then go for that. I think one thing that's key, especially during a volatile time, is to keep my investment philosophy simple and focused, so that when things do get pretty rocky and can be otherwise stressful, I can really focus on the task at hand and really take advantage of the situation. Nothing listed in this plan is revolutionary, but it can be very hard to follow nonetheless. But otherwise, if you guys want to see more episodes of this series as I continue my march towards $100,000 in the portfolio, we're actually over 80% of the way there, which is pretty cool. If you want to stay tuned for that, then definitely subscribe. I put out a new one of these episodes every single month. Otherwise, check out the affiliate links in the description below, smash the like button, all that great stuff. But until next time, take care.